Hi, everyone. Dale Pinkert here at TradeGATEHub.com, and we're fortunate to have Ben Maldonado back with us. Ben, welcome back. I think you were here about a year ago. And
That's right.
yes, and a lot of things you were talking about have manifested, and it looks like things are starting to speed up. So I'm interested in being updated on the Epoch Cycle and the 1970s analog. Why don't you just take it away, Ben? Looking forward to learning.
Always great to visit with you, Dale. I find that when you and I get together, we get exchange ideas. You see things differently than I do, so it always helps. At least me, it always helps to talk to other people and get their takes on things, and look at different angles that I may be missing. So,
Ben, it's a great point because a lot of people. I do this to edify the communities that I'm at. But I also learn a lot myself and a lot of things that fit my narratives and what I'm seeing technically. When I hear it from guys like you, it actually adds conviction to that type of trade. So you helped me as well, and I've learned a lot of things from you. So
excellent.
What do I do with my $10 million?
All right, we're going to have that wrapped up by the end of the presentation. Okay. So this is a little outline that give you an idea of the journey we're going to take today. We're going to start sort of really big and then sort of come down into ideas for you to consider and things to look at and angles on how to sort of play these bigger pictures. The first thing we'll start off with is the Epoch Cycle, which is a 400-year cycle that is sort of governing what's going on in our societies. And it's been here for a long time. We're coming to the end of it, and we'll go into what that means. What's the cycle? What did the cycle do? What does it mean when it's ending? And it's funny because Dale and I have talked about this before. What's the Great Reset? Everybody's talking about the Great Reset. Well, this is, in my opinion, this is the real Great Reset. This is what's bringing these massive changes that we're seeing. The other cycle then coming in a little shorter, 40 years is a long time, but when you're comparing it to 400, it's shorter. We go back and look at the 70s analog. My theory for I think it was about 2 or 3 years ago, I sort of found this in my research that the cycles that we're experiencing now are very similar, are the same ones that were around in the 1970s. And what does that mean? And what kind of consequences is that causing in our economy, in our markets, and in our society?
Would you say more magnified, Ben, than in the 70s?
It sure feels like it.
Okay, like you could have an earthquake that could be a 2.0, and you could have an earthquake that's a 6. So I'm wondering if this analog, since we're approaching the end of the Epoch Cycle, is gaining in intensity from 50 years ago, actually.
Yeah, you're right.
50 years ago. So what do you think?
I think that's an excellent observation. And I don't know if it's because of there's more people or there's more instant communication. So we're more connected, and maybe that's why. But I do agree with you that things are amplified and magnified for sure. So we'll go over that. We'll talk about the themes and the cycles for this year, what the background weather is supporting for 2022. We'll go into the first quarter, a few things that I've already noticed and have noted are taking place already in this quarter that are fitting with what's going to happen in 2022. My ongoing thesis is based on the energy crisis we saw in the 70s and sort of events particular to right now. We're heading to, if not already in, the second energy crisis that we've experienced. And then inflation, the CPI to the report today, I think, is just confirming it's hot. It's not going away. If you go to the grocery store, you go to the gas station, you see it in your everyday life, and everybody's seeing it and feeling it. So these are the highlights, the sort of outline that we'll cover. Let's get into it.
It's also very political. like it was in the 70s when people wore win buttons.
No question about it. It affects the politicians, and if they ignore it, it's to their own peril. They're just not going to be around if they ignore it. So let's start big. The Epoch Cycle is a 400-year cycle, started in the 17th century and early 1600s, and it was responsible for sort of how we organized societies, how we organized civilizations on the globe. So it was it was a system where we started developing these organizations that we used to run society, institutions, large, small, local, federal, global, all these things started forming in this cycle. We're at the end of the cycle. We're within, 4 years is 1% of a 400-year cycle. We're in the last 1% of it. And what we're currently experiencing is the fragmentation phase, where these institutions begin failing people, leading to a loss of trust, belief, faith, dependence, and creating a transition to where we're going to have more decentralized support systems, where people are going to be relying on themselves and relying on smaller communities as opposed to these bigger institutions.
I must add that you did a year or two ago talk about the Fed, and that was way ahead of all the trading that the Fed governors did, and led to resignations, and then loss of faith in the Fed that they made, miscalculation on letting loose money go
Right.
too long, and that's why we have this. So the Fed was in the crosshairs of this cycle.
Absolutely. And it's not that I'm some clairvoyant or I can see the future or anything like that. Is you look at what is the cycle supporting, and then you can see, okay, if it's the destruction and sort of the dissolution of these large, powerful institutions, who's more powerful than the Fed? Right. So I said it's logical that they would be one that's going to start feeling the effects of this cycle. Let's go to the next page, and you can see examples of some of these institutions that we've already seen.
What's it, Ben? What's the difference between a Fed chairman and God?
I have no idea.
God doesn't think he's a Fed chairman.
I like that one.
All right. So
that's a good one.
Go ahead.
So, I mean, we've all experienced this, and it's every day it's becoming, more sort of stark and in our face that these institutions are not what they used to be. And if we're going to continue to rely on them, it's at our own detriment. Media is an easy one, right? Everybody sees now. Who trusts the media now? Who goes to the media or newspapers for their news anymore? Hardly anybody, right? Because you can't believe them, right? You don't know whether they have an agenda, whether they're telling the truth, whether they're creating a narrative, whether they're being controlled by someone else. So the media is one. Organized religion. We've seen, the participation in organized religion at all-time lows. Government's an easy one. Not that people, some people never had faith in government, others had a lot, but you can see that the attitudes about government. I'm not a person who trusts government, who has ever trusted government. I'm more on the libertarian side, but I can see the difference between now and 5 years ago, 10 years ago, 20 years ago. You don't have the same faith that they're going to do the right thing. And that's what's leading to this sort of dissolution that people have in these organizations. Education systems, we're seeing that now playing out just look at all the clips of these school board meetings, and that shows you what people think about education right now. The multinational organizations, their credibility is shot. Federal Reserve, Dale brought up, in the last two elections, we can say sort of democracy and elections are being questioned anymore. Supply chains, utilities. Recent ones would be doctors and medical field, CDC, big tech. Now that they're censoring, people are losing faith in them.
You have NATO up there. If NATO hasn't had a test like this since the end of World War II.
I agree. I agree.
So,
And
if it's following the Epoch cycle, we shouldn't expect much out of NATO.
I would expect nothing.
Okay.
The two that I have question marks because they're sort of in transit, or they're working right now. They haven't sort of reached a conclusion. Fiat currency. I mean, Dale, you're big in the currency markets. People losing faith in fiats. Sure. Banks, they're getting disintermediated. They're getting, do people believe in banks anymore? They're not lending money, which is why this, overnight repo facility is so large. They don't want to lend money, and that was their original purpose, is to provide loans for businesses and individuals.
Why do you think they're so motivated to still put out like 0% balance transfer, credit cards, extending credit to the consumer, and not make business loans?
I think because the margins on that are so high that even though they know that they're gonna, the loss ratios are going to be higher, they make so much money there. I mean, that's 18%, right? 18-20% interest, so you can have 10% delinquencies and still do fine.
Okay.
So anyway, the key takeaway from this is that we can no longer depend on these institutions. They're failing, and they're going to be replaced by something else. We don't know what that is yet, but there are smaller, decentralized types of organizing structures.
FEMA camps.
So the 70s, which I talked about in the intro, the cycles we're experiencing now are the same cycles we experienced during the 1970s. Doesn't mean events are going to transpire exactly the same. It just means that they're most likely going to rhyme. They're going to have similar themes, but as Dale pointed out, things are magnified now and amplified, so it's different in that way. The main takeaway from this is that this slide is that in the 1970s we had an unpopular Republican president, Richard Nixon. Today, in the present day, we've had an popular with some, but overall very unpopular Republican president in Donald Trump. And on the list, you can see the events that happened. And I've gone back and I've researched the 70s to see these sort of things. They are eerily similar to what Trump went through, what Nixon went through. We've had 4 presidents impeached in the history of the country. Half of them happened here in this connection, Nixon and Trump. That's it.
And then what followed them?
What followed them was incompetent Democratic presidents. In the 70s, we had Jimmy Carter. Present day, while his term is not yet completed, the writing is on the wall. I mean, this guy is just...
You call him Jimmy Biden.
I call him Jimmy.
Admit it.
I do. I call him Jimmy Biden because, and it's not, again, it's not a political statement. What I'm making is not a political statement. It's about the cycles, right?
Yeah.
Trump is Nixon. Biden is Carter.
Yeah.
And if you look at the things that are happening and the things that happened during their presidencies, man, it's crazy how close they are and how they're mirroring each other. I mean, the first Earth Day was in the 70s. Biden's all about the Green New Deal and ESG mandates and all that. That's an example. There were record low birth rates in 72 and 73. In 2020, the birth rate was down 8%. We're near record lows. I mean, it's not by accident that this stuff is happening. The boycotting of the Moscow Olympics in 1980, Carter did that. And Biden is boycotting the Beijing Olympics. There's no U.S. delegation going. The athletes are getting to go,
right?
And they didn't get to go under Carter. So you can see that's where the cycle's not exact, but it rhymes.
They say cycles don't always repeat, but they rhyme.
Absolutely, and
so there's a rhyming in that anyway.
And that's the example. The big one I think that's coming that presents investment opportunities. The energy crisis of the 70s, everyone that studied history or lived through it knows about it. And I think we're in the process of of creating the second energy crisis in this
Would
country.
you be long energy assets up here at $90 WTI?
It really, Dale, it really depends on your time frame. From a tactical standpoint, no. I think, crude's probably going to take a break, and we'll look at the crude chart later in the presentation. But longer term, absolutely. I mean, because things are the supply demand dynamics are just setting up for, a major crisis and price spikes. Now let's go to the year. For 2022, the themes that I'm looking at, and I'll go over each one, but let's just hit them. Limitations and shortages. The myth of eternal growth is going to be shattered this year. I think we're already starting to see that. Volatility, not just in the markets, but in society, and then power, might, and violence.
That's me.
Limitations and shortages.
Peace,
this one is key. This one is key for investments.
Yeah.
We're not only seeing it in goods like food, semiconductors, we're seeing it in workers.
Yeah.
We're seeing it we're going to start seeing it in liquidity as the Fed, retracts liquidity. Yeah. We're going to start seeing it in growth. Yeah. So it's really bad for the economy and not great for the markets, because remember, the economy and the markets and our systems are built on the assumption of eternal growth, right? There's going to be more. We're going to have more. We're going to have more. We're going to have more. What if we don't? What it is good for is commodities. Commodities are super, like everything in economics, it's supply and demand driven. But if you get rid of or restrict supply in any way in a commodity market, you get moonshots, because they're generally in balance when prices are sort of going sideways, which commodities do most of the time. But when those imbalances occur, you get moonshots. And I think
could you possibly make the distinction between economically sensitive commodities like oil, copper, base metals, compared to agricultural commodities, which really don't care if we were in a recession or not, and there was slow growth. It's more dependent upon weather. And I don't think the Fed has much influence over food markets.
No, you're
are you going on a diet?
I wish, but the issues I think are exactly what you're saying, which is, and you've said it multiple times, you can't print corn.
Yeah.
You can print money, but you can't print corn. You have to put it in the ground. You have to wait for it to grow. You have to make sure that the weather is done right. And the big issue in the agricultural commodities now is fertilizer.
Yeah.
There's a major shortage of fertilizer, and it means that farmers can't plant certain crops.
They've always been the bravest people on the planet, in my opinion.
No question.
They take the risk, put all the work, investment into a crop, not knowing what the crop will bring. And if prices are high, it's because people don't have a lot of yields. So they get, high prices with a short crop, and a bumper crop, they get lousy prices. So
that's right.
Got to respect the farmer.
But this is an example of where, limitations and shortages in one place. Fertilizer.
Put my straw hat on, buddy.
Fertilizer is having a dramatic effect on the commodities, the ag commodities. So I think there's going to be all these kinds of ripple effects, and it's not great for economic growth. It's not great for society. It's very good for commodity prices. Second one,
as part of that, excuse me, Ben, supply chain, that China was a major supplier of fertilizer, and they're not shipping any.
Russia too.
Russia too. Oh, all our friends have the fertilizer.
Right. So I think, yes, that is part of it. I think it's a little too simplistic when people say, oh, these issues are going to be resolved through the supply chain. They're going to right themselves. Don't worry about it. I don't think that's true.
Okay. Even if, we're not going back to the way it was, but even if some of the issues are resolved, it's not about the supply chain. If we're in an adversarial position, with countries, they would use that as leverage if there are things we need.
No question.
Okay.
No question.
Yeah.
Number two, the myth of eternal growth. Modern systems are built on this principle. In other words, we need growth to support
Debt.
society. We need growth to support debt. So we need workers to support retirees. All the systems, if you look at it, we need growth to increase taxes to be able to pay for all the things that the congressmen are spending money on. So growth is the basis of the system. There's the more philosophy is going to fail because the growth's not going to be there. The background frequency, again, is not supportive of it. Does it mean that, we're going to have a Great Depression? I don't think so. I don't know. But this basing things off of and saying everything's going to be fine because we're just going to grow our way out of it is not going to work. And the attitude that
why has it worked so far?
I think because the cycles, the larger cycles, were supportive of it, right? They built the systems based on those cycles, and the cycles were supporting it. Now, as we turn and the cycles aren't supportive of that, of these massive systems that require growth to support them and maintain them, that's why I think it's going to be an uphill battle. And, most of us who are, over 30 have grown up believing that, because this is what our parents told us, that the future is always going to be better. Like, we'll have it better than our parents, who had it better than their parents, who had it better than their parents. Well, what if that's not true anymore? What if the future is not going to be better for subsequent generations? And I think you're already starting to see that, where the millennials don't have that belief. They don't think it's going to be better. They think it might be worse, in fact. And what that may lead to is some sort of emotional crisis and hopelessness, which doesn't really support a strong economy or booming economy or things being rosy. So that's
for them, the direction of crypto probably affects their moods.
And that,
right?
You're talking about the most volatile asset there is, and that's a tough thing to pin your mood on.
Yeah.
But I think you're right. And if so,
mine used to be dates. That's all I care about. Who cares about money?
The other thing about this myth of eternal growth is, in this cycle, expect frauds to be exposed. It's sort of like, when the tide comes in and you see who's not wearing a bathing suit, that may start happening, because it's not going to be able to be covered up because everything's growing. You're going to have to actually see something that really grows to get a good valuation in the market. So that's another thing. This don't invest based on the philosophy that we're going to have eternal growth, because I think you're going to be swimming upstream. Volatility. We've already seen volatility in the markets over the first month and a half of 2022. So everyone's familiar with that volatility and the sudden change in directions. I think the one thing that people have to look out for, and we're already starting to see it, is volatility in society and volatility in the directions we're going to go in society. And we're going to go into a couple examples of those in the new directions on the next slide. But what that's going to cause is it's going to cause emotional extremes. Like, just think about big up days, big January 6th, big up days. How do people feel in the market versus big down days? How do they feel in the market? The key thing for trading and in the markets here is, I think, discipline is going to be rewarded in trading systems again. For the last 13 years with this easy money, all you had to do was buy the dips or buy the most speculative shit, and you made the most money. I think those days are over. I think now you're going to have to be disciplined. You're going to have levels. You're going to have a trading system that you follow if you want to be successful in the markets. I mean, just look at yesterday and today. Yesterday we were up huge. Today we're down huge. If you're just trying to buy the dip now because it worked for the last 3 years, 5 years, 10 years, however long you've been investing, I don't think it's going to work. And I think it's going to be a lot of pain for people that don't have discipline in their trading. The last one, which Dale said is him, is power, might, and violence. This is about controlling the narrative. And there's going to be, and we've already, I think a perfect example of it recently is this whole Joe Rogan situation, right?
Mm-hmm.
This wasn't about Joe Rogan being a racist or Joe Rogan putting out disinformation or Joe Rogan's a bad guy. It's about his influence, right? Because 11 million people listen to him, listen to his podcast. He's got a lot of influence. CNN now at night on their primetime shows gets less than 1 million viewers. So that's a threat. And they don't control Joe Rogan. You know, the powers that be that want to control the narrative, they don't control him. And that's
how many viewers does Fox get at that time?
I only think it's, a little over 1 million.
Same as CNN.
It's better than CNN, but not much, maybe 10, 20%.
All right.
But you can see the massive difference, right, in the audiences. And so this controlling of the narrative and the total intolerance for any dissent is going to be a major theme this year. They're going to try to crack down on anybody who's not towing the line, who has influence. And I think Joe Rogan is a perfect
target.
Yeah, he's a perfect example of what they're going to do.
Okay.
So let's look at Q1. What Q1 new directions? We talked about the volatility and things going in different directions. A couple examples already in Q1, I think that you can look at, and it'll help you sort of tune in and be aware of and pick up on these changes as they're happening. Look at what's happened between November, December of last year and January, February this year on COVID policies and attitudes.
Yeah.
Countries are ending the restrictive policies. Companies as well. And companies that, are not exactly right-wing type companies either. I believe COVID as an instrument of fear is over. I don't think they can use it. Powers that be, whether they're politicians or, people pulling the strings in the background, I don't think they can use that to get what they want anymore. So they're going to have to use something else. I think we're moving from a pandemic to an endemic where we're going to have to start to just get used to it and live with it. And from the standpoint of society, that's a good thing. But the thing that's important and why I'm pointing it out is it's a completely different direction than we had just a couple of months ago.
That's quick.
Completely different. Federal Reserve policy. I believe that the liquidity and the risk party is over. People are, when I post that on Twitter, people are, what are you talking about? They send me the charts. We're down 5%. We're only down a couple percent off the highs. What are you talking about? Just buy the dip. And I said, it's over. And the reason I believe it's over is the Federal Reserve is telling you it's over. They're changing what they're doing. They realize that this is a major problem. I think it's too late, but they realize it's a major problem.
And isn't there quite a lag effect from when the Fed starts implementing policy and to when it really starts taking effect of at least 6 months or so?
That's right. In the real economy, yes. In the markets, it's almost instantaneous, but you're absolutely right. In the real economy, there's definitely a lag. And I think the thing that sums it up is, everybody, if you bought the dip for the last 13 years, you beat money managers, you beat S&P 500, you beat everybody, right? You did really well. You got to sell the rip now. It's time to preserve capital. It's not time to buy the dip because distribution is happening. Institutions are de-risking. They have been de-risking since November, December, January. They're doing it. You can see it because every rally at some point now is not making higher highs. It's starting to turn down and go. and go lower. So that's a big thing. That's a big difference.
Right now, what's happening this week could be the failing rally.
Could be.
Could be.
Yep.
Okay.
Could be. COVID policies change course. Here's just a couple examples: Switzerland, England, and Starbucks. Again, Starbucks is not an example of the mypillow.com or whatever the super conservative guy's company is. Yeah, it is right. There's a very liberal company with sort of progressive values. They're changing their mind. They said, we're done. No more requiring vaccinations. So this is big. And it's just happening. You're seeing it in more blue states, New York, California. They're all starting to roll things back. Big change. Remember when I said the Fed is telling you that they're going to be doing something different? Every day they come out and they're saying these things. So if we don't listen to them, it's at our own peril, right? They have the big stick in the room, and if you don't listen to them, they're going to take it and whack you over the head with it. But they're all saying we're going to raise rates. We have to keep inflation under control. We're going to yesterday I saw another Fed governor was talking about how they're going to reduce the size of the balance sheet and start selling bonds, not just letting them mature, but actually selling bonds. Yeah.
They want to book profits.
That's right. Absolutely right. So again, the key thing here is there's been a change. When the market changes, as a trader, you must change.
Yeah, Marty's wag, don't fight the Fed. So if the Fed has changed, don't fight it.
That's right. And if you followed that thing for the last 13 years, you made tons of money.
You sure did.
And you have to listen if you want to hang on to that money, because they're telling you things are changing. All right, let's go to the energy crisis. Why do I think we're going to see another type energy crisis that's an echo of the 70s? There's some fundamental reasons, and then we'll look at some of the charts. Peak supply is going to happen before peak demand. That, again, in the commodity world, is a recipe for high prices and moonshots in prices when it's unexpected. Peak supply is expected in 2024, peak demand in 2030. And why is that going to be that supply demand imbalance? It's all about these ESG mandates and green requirements and restrictions. Investments in oil and gas are near 75-year lows. And usually what happens, why the market stays in balance and why you see prices come down, is as prices go high, they start increasing the amount of money. The oil and gas companies increase the amount of money they're spending on exploration because it's so profitable. And what does that extra supply do? It brings prices down. That's not happening. Those investments aren't happening. So given a certain level of demand, if we're reducing supply, we're going to see higher prices. The other thing we're seeing is policy mistakes from government, shutting down coal or nuclear plants, canceling exploration leases, strategic petroleum reserve releases, all those things, while sort of great for the PR, economically make the problem worse. And we're seeing all of those things happening. So you've got the sort of perfect storm coming up to create much higher prices in oil and gas.
With all of our resources, what a tragedy.
It is a tragedy, absolute tragedy. Here's an example of a policy mistake that happens, but you can see it happens a lot. Yeah. What happens when the government symbolically says, oh, we're going to release oil from the strategic petroleum reserve? Well, prices go up. Yeah. It doesn't solve the fundamental problem. It's like a heroin rush, right? It's quick. It doesn't last. Here's a chart that shows oil and gas discoveries. Mm-hmm. And you can see
no one's looking.
No, they're not investing in it. They're not investing because they're almost being shamed. It's like the cancel culture will come after them if they do it.
Yeah, the wokes.
the wokes will come after them. And that's that. Woke is a good way to go broke. I'm not making any judgment on it in terms
And it's
of,
not a joke.
I'm not making any judgment on it in terms
All
of
right.
morality or any politics or anything like that. From an investment standpoint, it's a way to go broke. And an
Okay,
economic standpoint.
We needed a new way.
Yeah. So here's crude. Crude is this is a monthly chart. All the things I'm going to show you are monthlies because we're talking, not tactically, but big picture, strategic sort of investing here. Crude to me looks like it's set to go higher still. I mean, this level here, which is around 90, 91, 89 area, if we can hold that, we have an opening to go much higher.
Why don't you tell people a little bit about your squares?
Yeah, so the squares are, this is geometry. Essentially what these squares tell you is they help to sort of bracket prices, because if you look at a blank chart, there's no reference points on the chart, right? It can go anywhere. What these squares do is give you points where the probabilities of one thing happening over another are higher. So when you're under a square, let me give you an example of being under a square. Okay, so here we came down. Let me show you with the cursor. So here we came down, got below this square, and then came back and tested it. And that test tells you the square held, and probabilities favor that we're going to go lower and head down to this full square, which we did. What oil has been doing since the low, look where the low came, right on a square, went up, tested the square, came up, found the new level here and tested this square, took 3 or 4 months to battle it out and see which way we were going to go. We went up, tested the square, went up, tested the square again and held. And now we're looking at breaking out to a new higher level. If we can stay above this, this, as I said, this, 91, 92, 93 area, I would say give it a range, give it like, 80 to 90, keep it tight. If we can stay on top of this, we're heading much, much higher.
What's our next square high?
The next high, let me see, oil, we're looking at like 114.
Okay. And where did it break out? What was that square it broke out at?
Down here was about a support, was like, I think I can't see the chart because these aren't live. These are screenshots.
Oh, okay.
But around 75 is support, which is this half square here.
Okay. So probably around 50 or so. Yeah. Okay. Thank you.
Crude, very bullish long term. Natural gas, another one we were on last summer. You can see again, it was this is the pattern you're going to see in a lot of commodities. Crude is different because we had that huge spike down. But look at the base here.
Yeah. Years.
I mean, you formed a base for, 10, 11 years where we went sideways, with a downward drift. Now we've broken out. We tested this square on that big spike in last fall, pulled back, found support on the half square, and now we're going to be back up in here testing again. But longer term, this thing looks like it wants to go higher.
It's a bullish chart.
Very bullish. And it's a monthly. This is not a 5-minute or a 30-minute chart. This is a monthly chart. So these signals last years on these type of charts.
I'd hope for an ABC on that.
Yeah, minimum, it's still a nice target. This is an example of why, it's not just the Fed talking, they're hitting the brakes. This is the Goldman Sachs, I think, financial conditions indicator or index they have. Yes, we're still in easy money, but you have to look at the direction and the rate of change. It's heading towards tighter, which is not bullish for risk assets. And that's key. Rate of change here is key. A very important thing that I've noticed in my research is that it's taking more and more debt to produce less and less growth.
Right.
And that's why I believe why we're seeing the inflation kick up the way it is, and why during the next crisis, they're going to have to use a bazooka of liquidity.
They will.
even compared to what we saw in 2020.
Yeah. They'll buy stocks.
They're gonna. I have no idea
They'll
what
try
they're gonna
everything.
do. I think you're absolutely right. There's a good chance they're going to buy stocks, but the amount of liquidity that's going to come in is going to be crazy. And here's a perfect example of it. The liquidity, the combined recessions from 1980 to 2007, in the last one in 2020, the amount of liquidity they used exceeded the combined amount they used previously in those recessions. And so that the next one, they're going to have to do even more. It's like, they need more heroin to get the same high. And that's a problem. It's not a problem though, if you're positioned properly for it, right? If you're positioned properly for it, with what is this going to mean? It means commodities are going to boom and inflation assets are going to boom. Here's an interesting chart I found that I thought I would share with you. It's a correlation between the Fed balance sheet and the S&P 500. One is a perfect correlation. The correlation in this study was 0.93. So if the Fed is going to be reducing their balance sheet, what does that mean for the S&P 500? If the Fed's balance sheet's going down and it's almost perfectly correlated with the S&P, it means probabilities favor. It's going to be tough sledding in the equity markets. We always call bubbles. Everyone talks about bubble this, bubble that. It's really helpful to look at these charts, because almost all bubbles follow this pattern, right? Where you have the beginning, little pullback, major move higher, and then you get this. I think we're somewhere in here, man, and I'll show you on the S&P. And to know that we're in the bubble of bubbles, I read the other day that metaverse mortgages are being issued now to buy virtual land.
Yeah.
That's a bubble on a bubble, man. and you know what? Maybe it works out. But in the long term, in the short term, that always gets punished. Always, always, always gets punished. And so it's not a matter of if, it's a matter of when.
Yeah.
So remember this.
We need a metaverse because you can't go anywhere except in your head. I'm very bearish. I'm not a fan.
Right.
It's almost like against human design. We're meant to be social animals and, know each other and have a community and shake hands and communicate eyeball to eyeball. And now we're taking the next step where we won't even have to leave our house to have any reality we want.
But I'm with you, Dale.
I'm still, put me on a beach with a cold Corona. It's really going to have to be a special program to to fool me, man.
I'm with you. There's nothing like feeling the sun on your skin.
I don't know. I sound like my dad. I sound like my parents now.
I know. I'm
maybe trying, my grandparents.
I'm not trying to yell, "Get off my lawn," and yell at the clouds. But
I miss those days. Get off the lawn.
But what are you going to do? I mean, it's the thing that I would say is the younger generation has been used to this. It's what they were been raised on, and they're comfortable with it, which is okay. I'm totally cool with that. I'm not saying don't do it.
Yeah.
The only thing I am saying is, a lot like the cycles, they're ever present, and we're human beings, and you cannot change human nature. It doesn't change. That's why the cycles work.
Yeah.
Right. The fear, the greed, all the things that happen is, as evolved as we think we are, we're still subject to those emotions of fear and greed and wanting companionship and love and all these other emotions that we experience. If they can produce that in the metaverse, it's probably going to work. If they can't, it's not.
Yeah.
Anyway, we'll see. But here, remember this pattern, because I want to show you something that looks eerily similar to me.
Okay. All right. Yeah.
Looks similar, doesn't it?
Yeah.
Let's go back.
Yeah. Failing rally, bull trap. What we're getting right now.
That's what we want to watch, right? This is why it's so important to watch this next rally. Because if we make a lower high, watch out.
Yeah, we haven't had a failing rally in a long time.
If we make a higher high, watch out for a false break.
Yeah.
I heard you on your other show this morning talking about, the stop hunts and things like that. Listen, if you're trading and you don't believe that, you're missing out, and you're going to get picked off. It happens all the time. Go look at your charts. Look at before major moves. Watch how they clean out the lows before they make a big move higher, or watch how they make a marginally new high before they turn down. It happens all the time. So this is my speculative path. I think we're setting up for a large down move. According to the cycles that I work with, we're looking at the next crisis starting sometime in March.
You have any time in March? How about around the spring?
The vernal equinox?
Yeah.
That's what, the 20th, around there?
Yeah, around there, I think.
Yeah, there's some timing around there. There's some timing in early March. I'm really trying. I just know that March is going to be the pivotal month in my stuff. So I'm watching price action for clues, because, maybe it comes the last week of February. Maybe it comes, April 1st, or, late March. You can't be that when you're talking about big cycles, you can't be that precise. So price action dictates everything. And if we get this pattern that you're seeing on the screen, where we make a lower high and are rolling over, or we make a marginal high and right away, pull back into it, it's going to be go time. So
yeah,
March is when.
So you're looking for, I know your levels aren't accurate here, but I don't know why it would be the end of the world if we pulled back to the peak before the COVID crash.
Right, in that area. Absolutely. Yeah. And then
those were all-time highs
right
before the sell-off, so we just would be giving up the Fed, like you said, the Fed providing extraordinary liquidity during COVID and fiscal, and that going away. Fiscal's not there anymore, even the child tax credit. There's less money flowing out there.
Yeah. And if we just, as you said, come back and test those highs, that's where you're talking about. Now, this potentially big move up would be
the Fed,
the tsunami of liquidity. That's right. Absolutely right. And what that has, obviously, for risk assets is tremendous. But think about your real assets or your hard assets.
Will they get cheap on liquidity on a big break in equities like you're showing here? Will commodities be able to withstand the liquidation pressure of major sell-off? You're talking, looks like 40%. So is gold going to perform? Is oil going to perform? If it's about recession, or China locking down their whole country, or Russia, or who knows? Maybe it's not the time to be long the world until that completes.
I think you're right, Dale. The reason why is not that they're not fundamentally good for the environment that we're going to be seeing. It's
just a liquidity issue.
Exactly. If I'm getting killed in the stock market and I need to meet margin calls, or I need to raise cash, I'm going to sell everything.
I'm going to sell my oil assets. In fact,
I'm going to sell oil. I'm going to sell gold. Everything gets sold. Right.
How about this? Especially since, there were a ton of new traders who came in during COVID. They got their checks. They opened accounts at Robinhood, but we could, so they've seen nothing but extreme bull moves and things, crypto, etc. But there's also been a much larger generation from the 08, 09 lows after the housing crisis that really haven't seen, much of a bear market either, that if they just stayed the course, they'd be fine. So, I think there's a lot of inexperienced people who have never even seen a bear unless they went to Yellowstone.
I'm with you, which is, if that's the case, the best thing you could do is go to cash.
Yeah.
Go to cash, wait for the crash or whatever's going to happen, if it's going to happen. Remember, we're not dealing in certainties here. You have to understand that in the market,
guys looking for 6,000.
It might happen.
And then an 80%.
Right. That might happen. I mean, listen, the key thing is you got to deal in probabilities, right? And then the market either confirms or it says something else is happening.
You probe and protect, right, Ben? I mean,
and you gotta listen. You gotta listen.
Yeah. So you may attempt to get on a position more than once, be taken out, and it goes to the next level, and you try it again. And the minute you turn your head and give up on that trade, it'll happen without you.
Absolutely.
So you know why I say that? Because I've experienced it. So
amen. I'm with you.
Anyway, great presentation. Anything you want to wrap it with, buddy?
Yeah, let's just go quickly through the inflation issue.
Oh, okay.
There's been so much talk about how inflation is transitory. It's not going to go away. It's going to go away. Don't worry about it. It's not going anywhere. And not that Goldman Sachs is God, but they do see things that the mere mortals don't get to see. And look at this quote from the head of their head commodity strategist. I've been doing this 30 years and I've never seen commodity markets like this. This is a molecule crisis. We're out of everything. I don't care if it's oil, gas, coal, copper, aluminum, you name it, we're out of it. Doesn't that sound like limitations and shortages?
Yeah.
That's going to be persistent. At least
when in your lifetime could you have made money selling your used car?
Never.
Right. I rest my case.
Right. So let's go. Here's an interesting chart. I think you got to study history in the markets to have a better idea of what's happening, because it does repeat. Not perfectly, but it rhymes. And that's the essence of cycles. We constantly go through periods of inflation and then deflation, inflation, deflation, inflation. We just finished a deflationary cycle. An inflationary cycle has come. That's why it's not transitory. That's why it's sticking around. That's why the Fed has done a 180 on inflation. Go look at what they were saying about inflation 6 months ago.
Yeah.
They know now. And more people are going to pick up on this. And being early of a major trend is how you make a lot of money.
I asked one guy, do you think the Fed's making a policy error? And he said, they always make policy errors.
There you go. Gold, been correcting for 18 months, frustrating bulls and bears. But just look at where, this wedge here's, look at where we've been consolidating. Look at where this whole correction is taking place. Right at the highs from 2011, 2012. Anybody who knows technical analysis, that is a sign of a bullish chart. You're consolidating above previous highs or at previous highs or in previous highs. It's bullish. Gold's going to break out. Silver. There's that commodity pattern, right? Big down, multi-year base. Look at that clean out low. Remember I told you about, we were talking about those stops. They take it down, clean out all these stops from years, right? People that had their stops below these lows and then ramp it higher. But look where we're consolidating. Look at where this triangle is happening. Right above all this stuff. That's bullish. I don't know that it means it's bullish today or tomorrow or next week, but big picture, long term, it's bullish. Again, these are monthly charts. Copper, same thing. Big run up, been chopping for months and months and months, frustrating everybody. I believe it's just starting to break out too. Really, really ramped up yesterday. Shorter time frames, you can see it. But this whole consolidation is happening right in the area of the previous highs from 2010, 2011. That's bullish. Huh?
So
no, that's bullish. That's bullish.
That's what makes a market.
That's right. Here's the ags, wheat, big base breakout.
That's great. Yeah.
Bullish.
By any pullback.
Corn, big base breakout, pullback. Now this one's a little further along, right? It's already had its pullback and we're making the next move up.
Yeah.
Here's the king of the grains right now. Look at beans.
Yeah.
Big base breakout, pull back, making new highs.
That's how I know this is magnified from the 70s, because if the war chant on the CBOT floor was beans in the teens.
Right.
Now they're always in the teens. They have to come up with something for the 30s.
Right.
There'll be nothing to feed the birdies when beans are in the 30s.
There you go.
Okay, so
excellent.
They're going to $30.
How about you won't be feeding the birdies?
Yeah, you will be eating bird seed.
Right.
All right. So beans, I love them.
Coffee,
okay.
just breaking out.
Yeah.
On a monthly basis. Again, these are not 30-minute charts.
Yeah,
people.
this
They're
is
monthly.
not decaf coffee here, guys.
No.
Go. Yeah. All right.
Sugar pulling back. As long as we hold.
Cancer.
It does, but it's pulling back as long as it holds, man. Again.
I remember 60. Cotton. Yeah. Buy polyester.
Maybe it's the 70s, right? We're going back to polyester.
Right. It was leisure.
They were
suits.
huge.
Did you have one?
I had an orange one when I was like 10 years old. For my 8th grade graduation.
I hope you stayed away from matches when you were wearing that.
1978.
Anyway, okay. Cotton, I don't even remember that last spike all the way back there in the 70s, but
no,
yeah.
In 2011. I don't remember that either.
I don't know what happened.
2011. Massive spike.
Yeah.
I think we're going to exceed that. I really do. If this super cycle of commodities happens, man, all these highs are going to get taken out.
Yeah.
Here's one that is just breaking out this week. So this is one you could say, oh, I missed these others. What's going on? Look at cocoa. Huge triangle, big base, multi-year base, 5-year base, and we're strongly breaking out above it. It probed a few different times. This time looks like for real. Now, we'll know on a pullback, right? If we come back into this mess again, then it's not ready yet. But these kind of formations, man, are powerful, and it's breaking out.
Okay.
Chocolate's going to be more expensive.
Okay.
Here's a chart that is going down, in my opinion.
Okay.
And that is the 30-year treasury. This is price. So this means yields are going higher. I believe that the 40-year cyclical bull market in bonds is over.
Yeah.
And we're in a new regime. We're going to see higher interest rates.
Yeah.
And if we're going to get this inflation, and if they're going to keep unleashing, tsunamis of money, rates are going to go higher. And the Fed may not be raising rates, but the bond market is raising rates. And
the bond vigilantes without the Fed buying them anymore. In fact, the Fed is going to be selling them.
Do you know we hit 2 on the 10-year today?
Yeah.
It sold off, but it hit 2.
Yeah.
So rates are going higher. That's the last chart. If you guys are interested in this kind of analysis and what we do, we don't charge for anything. It's all free. It's all how we keep ourselves accountable. We have this YouTube channel. We put a weekly video up, and then we review the monthly charts once a month. Dale asked about the squares. We have a video there that talks about how we use squares and explains price action and levels and how we use it. So it's really good if you're interested in the squares. And then if you want to try and get a hold of me, I'm on Twitter every day, and you can reach me at this Twitter handle.
Okay. And were you and President Trump classmates at Wharton?
No, he's a lot older than I am.
All right.
Although I do have a good story. I'll end with a quick story of Trump. So Trump came in when I was at Wharton. He came in and he spoke to like one of the Wharton clubs, and of course the room was packed because this is when Art of the Deal and all that stuff was going on, like at the height of his popularity the first time around. And so he's speaking, and I'm telling you, the room is standing only. It's in it's in one of the big hall lecture halls in Wharton. And so he finishes his talk, and then he starts asking questions. And one of the kids raises his hand, stands up. He says, "Mr. Trump," because he was Mr. Trump at that time. He says, "You're a prestigious alum of the school, and a lot of the prestigious alums give big sums of money to the school." And he goes, "I notice your name is not on the list of the largest donors." So he goes, "When should we expect you to be making a large contribution? And if not, why wouldn't you contribute back to the school that helped you?" And the whole room starts clapping and laughing and everything. And Trump kind of looks at the guy and he goes, "What's your name, son?" And the kid says, "David," or whatever his name was. He says, "I'll tell you what, David." He goes, "I'll match you dollar for dollar." And the room explodes and goes crazy because it was a perfect response and got Trump out of a hot spot.
Yeah, that is a good story.
Yeah.
He was quick on his feet, man.
He was fast. The guy had media talent even back then.
Yeah. So Ben, my trading warrior brother, thank you so for sharing. Very interesting Epoch Cycle and 1970s analog and some good looks at some monthly charts. Some just starting to perform here. Appreciate your giving spirit and sharing your stuff.
Always glad to visit with you, Dale. I enjoy our talks and I enjoy our friendship. And let's all hope we can survive this year and take advantage of the volatility, because as traders, that's what we want. All right.
Looking to flourish. Thank you, Ben Maldonado at Ben Maldonado at +3 Forecasting. Follow Ben.
Thank you,
buddy.
Dale. All right, man. Take care.
Adios. And don't just count your pips, count your blessings. Thank you, everyone. Hope you had a good week. And you have the video, if you're watching it live, to check out again. I'll see you Monday.